And then, there you go. All right.
I think if I'm the host,
We're
I
the
guess I can
hostess with the most
there we,
now.
there we go. All right. That means I got to know how to work this stuff. Oh, no. All right. Can y'all see my screen, my slides? Okay. Feel free to ask questions as we go. And this is just sort of a presentation to inform you on on how to finance real estate investments. And I'm presenting this from the perspective of these are normal ways, you know, like with anything in real estate, there are 1,000 different variations of everything that you can possibly do. But there's just normal ways that things are done. And then there's variations of each of those, which obviously we could be here for 2 days talking about all the different variations. So these are just kind of the common ways that people finance real estate investments and what you should kind of just be aware of if you're wanting to represent investors, and then also what you should be aware of if you are interested in becoming an investor or buying investment property yourself. So in my 30 years as an investor, I have run across 2 different groups of people. Typically, there's usually the group of people who just want some sort of a retirement supplement. And, you know, for them, it could look a little bit different. For some, they want to have 5 doors paid in full by the time they retire so that they're generating an extra $5,000, $10,000, $20,000 in monthly income, you know, in addition to Social Security and whatever other retirements they come up with. For some people, that might be 10 doors. For some people, it might be, I'm perfectly happy with 2. But that's kind of I call it the retirement supplement plan. You know, these are not creative people. I wouldn't even necessarily call them investors. They have rental property, but I tend to call them more just rental property owners than investors, but that's just my thing. Obviously they are real estate investors. And then there's the people who want to be full-time investors. The full-time investors are the people that you see run ads like We Buy Houses, or, you know, they run TV commercials or whatever saying, hey, we'll make you a cash offer on your house. Those type of people. Okay, these are people who are always looking for a deal, always looking for, you know, a $500,000 house for $450,000. And yeah, some of you might be going, well, yeah, who isn't? But the reality is that usually when a house comes with a discount, it comes with work involved as well, and not everybody's willing to do that work. So these are people who need to generate monthly income. Oftentimes they'll have a staff. It's very unusual for credible larger investors that are doing it full time to kind of be a single person doing it themselves. They'll have staff, so they have overhead costs, they have marketing costs, all that type of thing. And typically, not always, but typically they do multiple business models. And we talked about in my last training all the different business models. Obviously, just people getting started might only be doing one, but after they've been established and had a little bit more experience, you'll often see them doing, you know, everything from wholesale deals to rehab deals to buying and holding and those types of things. So I'm going to start out by talking about how to finance the retirement supplement type programs, which are most of your traditional type financing with a few little twists. And then I'll talk more about how the full-time investors do that, because it is kind of 2 different paths, if you will, for the most part. So for the supplement retirement people, let's say their goal is to own 5 paid in full doors, generating approximately $2,000 a month. And the free and clear obviously doesn't happen immediately. That typically obviously comes over a period of time. Obviously it can take as long as 30 years if they're getting a 30-year mortgage to get that free and clear. Most people, if they're doing it as a retirement supplement, will do some sort of escalated payment plan so that they're not living off any of the cash that their retirement properties are generating each month. They're putting that back into the property, putting some aside for CapEx expenses, and then using whatever cash flow they get off of it to pay down that mortgage to get those paid off more quickly. Now, of course, this depends on if you're starting at 20 versus if you're starting at 55. You know, so if you're starting at 55, you definitely have to do that if you want this to be a retirement supplement. If you're starting at 20, easy peasy, you can enjoy that cash flow and get those things paid off in time for retirement. So it's totally a little bit of a different look. Now with traditional lending, which is what most of those type of investors do, is traditional lending. You go through the bank, credit union, mortgage broker, whatever. And of course you're going to get qualified based on credit score, past history, payments, and all of that. Now, the pros are, of course, it's relatively inexpensive to borrow. And I also would add in here, a pro is that it's understandable. Like it's something everybody knows, basically. If you bought a home, you understand traditional lending and how it works. So it's not, you don't have to learn new things to go this route. The cons in certain situations can be that it obviously takes a while, 4 to 6 weeks sometimes. You are limited to the number of loans that you can have in your name. The bank's not going to just give you, 15 loans for rental properties without a lot of hoop jumping. And at some point, they're going to make you do some different things and get a blanket mortgage and things like that. So at some point, you are limited. Each of these properties is going to require a 25% or more down payment, depending on what type of loan you're going with, your credit, which method you're financing through, all that type of stuff. And in these cases, property condition is considered. So like, for instance, if you get an FHA loan, you know that there's a certain requirements that are going to have to be done repair wise that are not always going to be standard in a house that you're getting at a discount. So if you're trying to get the best of all those things, they don't usually work well together. It's like you can't have a really good discount on a property in great condition that you're going to be able to get financing for. Those things just all don't go together. And so in this traditional lending method, of course, the money and the credit that's required is what stops a lot of people from being able to achieve this kind of dream. Because if you think about a traditional house at even $450,000 and needing 25% down payment, it could take you 5 to 10 years to save that up to be able to do that. So it's not an easy plan to implement getting 5 of those under your belt. However, with a full-time investor, that can look a little bit different. Usually when I'm coaching new investors, the number one thing I hear is that they want to replace a $10,000 a month income. Now, whether they're actually making that or not, I don't know. We could debate that till the cows come home, but that's usually the magic number everybody wants to achieve. If I could make $10,000 a month, I'll be happy, is kind of their thing. So with the average cash flow per door of a rental property averaging from coast to coast, the average is $200 a month. You would need 50 doors at 10,000 to get a $10,000 income. Now, of course, there's a lot of things to consider. If you refinance one of those, you pull cash out, that cash is tax-free. So now you could spread that out over certain months. There's a lot of things like that that make real estate certainly appealing and beneficial to look at. But when you're just looking at the pure numbers of $200 a month, you realize that you need a lot of doors to be able to generate a decent income. Of course, that doesn't include any vacancies. And with the 20% down that you would be required to have, you're looking at about $90,000 per property. So that's some serious cash, right? And a lot of times when you're dealing with full-time investors, they're dealing with motivated sellers. Like if you run, we buy houses cash type ads, TV commercials, anything like that, Facebook, all that kind of stuff. A lot of the people who call you are people who are super motivated. They don't want to go through traditional means. They understand that their house is in top condition, or they have an urgency, like we talked about it at our last training about like a divorce, or they're moving out of state and they need to go quickly, and all those types of things. So they don't have 4 to 6 weeks to wait, which is why full-time investors look for alternative types of financing. They can't always go through the traditional means. You can't get a great deal and wait 6 weeks for a loan. If you're going to get a good deal, you need to be able to close on it pretty quickly. So they look for alternatives, and those alternatives can vary from things like transaction funding, insurance cash value, which is a loan to yourself, a DSCR loan, which we'll talk about, hard money, HELOCs, owner financing, and you can also, when we get to that part, sell the note from the owner financing to generate larger cash, and then private money. Those are all like some of the more common alternatives that full-time investors use. So let's take a look at some of those. So transactional funding is primarily used for wholesale loans only. And so in the last training, we talked about how does a wholesale deal work and why do wholesalers do the things that they do, okay? Well, a lot of times with a wholesale deal, I might be able to get a property under contract for 60% of the value of what it would be once I go in and do all the fix-up work, okay? But if I'm going to sell that contract, then I might sell that contract for like $5,000 or whatever. and make a quick $5,000 because I'm wholesaling that deal. If I don't get that contract sold in time, maybe there's a foreclosure pending or something with a time urgency deadline, okay? And for whatever reason, I don't get it sold fast enough, I can't get that contract sold, then there is something called transactional funding where I can purchase it and then hold on to it for a day or two. So typically transactional funding is only going to last for about 2 to 4 days. On average, most of them will allow you to keep it for 3 days. It's super cheap, which is one of the pros of it, that you don't need any credit. You're basically signing over your rights to the house, if you will, if you don't pay this back in 3 to 4 days. And it's a super inexpensive loan. Most people will do them between a 0.5 point or 0.5% to 1%. And it's usually pretty fast and quick on the approval process. Where this is super good is if you need to close on a transaction, like say your deadline is Monday because somebody's foreclosing, but for whatever reason, the buyer that you're wholesaling the property to, their financing or cash isn't going to be available till Tuesday or Wednesday, or they're getting a loan to purchase that property and the lending company says, we won't allow just a straight wholesale deal, an assignment. We want the person who's selling you this house to own the house first. Then that's when I would get transactional funding to purchase that house, close on it on Monday, and then you would be buying it from me on Wednesday. So that's kind of how that works. Insurance cash value, you can do this with whole life insurance policies and universal life policies. A lot of people don't know about this. It's pretty creative, and it's starting to become more and more popular in the real estate investing training world, where people are talking about it a little bit more. Essentially, the pros are you're borrowing from yourself because it's your own cash value and your own money. Payback is optional, which kind of makes it a little bit nice. If something happens, which, you know, things happen in real estate transactions. So if something happens and you intended to pay it back in, you know, a year, you were going to go in, fix the property up, and then pay it back in a year by refinancing or whatever, but rates go up. And all of a sudden now it doesn't make sense. You don't necessarily have to pay that back, which is nice. And then you could do it at a later time. It is tax-free borrowing. Of course, I am not a CPA, so clarify that with your CPA. But it is tax-free borrowing, which is really nice. There's no credit check required, and usually you can get your funds within a week or two with any major insurance company. So this is a common way that people today are starting to purchase real estate, especially since rates have started to go up. The cons, of course, are that it could reduce your death benefit, depending on how much cash value you have in there and how your policy is written. So you do definitely need to have that discussion with your insurance company. Some people consider a con to be that they're higher interest rates. I think it's still kind of funny because it's 7 to 8%. So to me, that's still pretty low. But yeah, I mean, it is higher than, say, traditional mortgage lending if you have 4 to 6 weeks to wait for that. And then, of course, another con is that your policy could lapse if you don't ever pay that back, because there's a lot of statistics that go into at what point does it need to be paid back before you've dried up all your death benefit, if you will. So, but it is a great alternative for those that, you know, have a nice large cash value policy. And there's all kinds of creative stuff you can do with it if you're into that kind of thing. Debt service coverage ratio loans are really picking up in popularity in the last couple of years. These are primarily used for long-term rentals. You wouldn't really use these for wholesaling a deal or for rehabbing a deal. This would be for a buy and hold strategy. And the debt service coverage ratio is basically a ratio of the property's annual net operating income and its mortgage debt. And so mortgage lenders are really looking at this. It used to be, these have been around forever, and we used to use them on apartment purchases all the time. Like when we purchased apartment buildings, this is always what you cared to get to, was a 1.2 DSCR. That was the whole thing. It's just recently in the last couple of years become popular for single family homes, and they're ideal for investors who don't have a steady income. You know, it's pretty common if you're a full-time investor, you just sort of live off of whatever happens to come your way. So you might go a month or two sometimes without any income coming in at all. So it's really hard to qualify through traditional means. But then in that third month, you might get a $60,000 check, you know, and so it's difficult through traditional means. So in this case here, you don't necessarily have to qualify the way that you do through traditional mortgages. They look more at the property, the debt service coverage ratio number, which they look for that to be at a 1.2 or higher. And then they look at it. They do look at your credit to make sure you're not a flake and all that type of stuff, but it's not the same as like a normal mortgage type process. This is often combined with the HELOC, which I'm going to talk about in a few minutes. So you'll see that a little bit. This is really relative. Yeah.
Courtney, real quick with so for this DSCR long-term, or for the type of loan, does the property already have to have had a history of rental use, or could you use it as like projected income?
You're using pro forma numbers to come up with the DSCR. So to come up with the ratio, you're going to use projected income, and then they'll base it off of that. And of course, the lender will do all their due diligence to make sure and to back that up. They'll want you to prove what you can rent it for and all that type of stuff. Okay. And so it's relatively inexpensive borrowing, no tax returns required, no personal income is necessary. There are some interest only options. I don't necessarily agree with those. Sometimes they work, sometimes they don't. I wouldn't advise them for long-term holders, but it is an option sometimes in situations for a short-term type of thing. There is no limit on the number of properties, which is why these have become so much more popular among buy and hold people. And they are great for short-term rental people. So if you're buying to do short-term rentals, these are fantastic. And there's unlimited cash outs, which is basically a refinance. So that's where we're gonna get to that when I talk about HELOCs. And there's no reserves required, which is really nice. So because with a lot of properties on traditional financing, they'll require you to have 3 to 6 months reserves sometimes. They can take as long as a typical loan. 4 weeks is not uncommon, and there is a down payment required of 20%. So in that sense, they mirror traditional loans a lot, but they can be right in the right place, which is kind of nice. Hard money. Now these are typically called rehab loans, hard money loans. You'll hear them called a couple of different things. Most people who get these are rehabbers. Okay, so they're rehabbers either buying from the MLS, a good deal that they found, or they're buying from a wholesaler or a friend that they just happen to hear about or whatever. Very few rehabbers actually do their own marketing to find their own deals. It's not totally uncommon, but it's rare. Hard money loans are known to be expensive with high interest rates of 9.99% or above. It's not uncommon in some markets to see that number as high as 15 to 16%. You'll usually pay points of 2 to 5 points. And these are short-term loans, usually 6 months long, with a right to renew for a 3 or 6 month term, depending on the company. And you will pay a fee to renew that. So if you don't get your rehab done in the 6 month period, then you're going to pay another fee on top of that. Money in these cases are given in draws. So very similar to like a construction loan, if you're familiar with how those work. They're going to give you, and they're not just going to hand you $500,000 and hope that you get the rehab done properly and that you get it done on time. They're going to come out and inspect the property. They're going to look and say, okay, you have, 20% of the work done so far. So here's 20% of the money, kind of thing. Then when you get 50% done, they're going to come out and look, okay, here's 50%. So in some ways, I feel like it's really good. New rehabbers don't like using them because they say it's so expensive, but it's like you wouldn't have had the opportunity without the access to this money. So you can earn nothing, or you can earn, $30,000. But yeah, you have to pay for some of that, But I also think for new rehabbers, it's a really good kind of almost like a checks and balance, if you will, because you do have somebody coming out. Look, first of all, hard money lenders do a pretty good job of analyzing the market to make sure you're getting a good deal. So obviously before they loan you the money, they want to make sure your numbers are correct, that yes, fixed up, you will be able to sell it for what you're saying, and that yes, your rehab estimates are pretty good and accurate. If not, they'll reject you, which is good. I mean, some people get angry about it, but it's like they just saved you from making a big mistake, which is kind of nice. And then because they kind of keep you to this timeline, I think that it's really good for new rehabbers because it's sort of almost like a secondary property manager for them, which is nice. The pros to this is it's fast. Like you can close in as little as 1 to 2 hours. My friend Lauren Howard from Prime Plus Mortgage will not like you very much if you call him and ask for this to happen in 1 hour. But he's done it for me on multiple occasions. But they can close these fast if they have to. 24 to 48 hours is usually considered a quick turnaround, but they can do it in a couple of hours. Normal for them will be a 5 to 7 day turnaround. There'll be no credit check. You'll only need 10% down for most hard money lenders in today's market. This is 100% asset-based loan. So they're looking to make sure that you have equity in the house. If you're buying a $100,000 house, I know those don't exist here, but it's easier for me to talk about the math. If you're buying a $100,000 house, they're not going to loan more than about $70,000 on that. So it's totally asset-based. They're going to make sure there's some equity cushion in there in case everything goes wrong. And then right now, what's really popular among hard money lenders is they're charging a slightly higher interest rate for people who are brand new, which makes perfect sense because you're likely to make more mistakes and keep their money longer. And then they're giving a much better interest rate to people that are experienced. As I said, it is kind of a second set of eyes on your deal, which is a huge pro. And then they do consider your experience, but they don't require it. And then there's no limits with their loans either. Did somebody have a question? All right, now the HELOC. The HELOC is a home equity line of credit. Of course, we just came out of some of the best real estate markets over the last couple of years. So a lot of people have really good equity in their houses. If investing is something that you're interested in, this is a really great way to get started. It's pretty cheap money. Obviously you can get a home equity. So if you, let's say your house, you bought your house at $300,000 and it's currently worth $700,000 because of the boom we've had over the last several years, you can get a home equity line for, I know companies that will do it as high as 95% of the value. I don't ever recommend that because if we have a slight downturn again, now you're upside down in your house. But if you can go to 80 or 90% of the value of your home. And so the rest of that cushion from that 300 to whatever 90% of 700,000 is, you can get that in a home equity line of credit. Now, what happens with the home equity line of credit is it basically becomes like a second mortgage on your home. And for most home equity lines, you get a checkbook or a debit card that just comes right out of that. And you pay it back as you need to. So as an example, let's say I wanted to get a hard money loan, but I need to have a $25,000 down payment to get that hard money loan because they want 10% down. Okay, but I don't have $25,000 cash sitting in the bank. Then I could use my home equity line of credit, write a check for that $25,000. So now instead of me owing $300,000 on my house, I owe $325,000. Okay, so I owe $300 to one lender, $25,000 to the home equity lender. Okay, but I'm making really small payments on that home equity line. Like for that amount, it might be $50 a month as an example. So I'm able to get in and do that rehab that I hadn't intended to do or I couldn't do otherwise. Home equity line of credit interests are really low. You can really work fast because you have checkbook control or a debit card, depending on the company. And so if I see a deal, I'm able to take advantage of that really quickly. And oftentimes, depending on how much money you have in your equity you have in your home, you can become a cash buyer for smaller properties. So if you have a good $200,000 or $250,000 worth of equity in your home, you can buy cash properties in many markets, and then sometimes here, if depending on the amount. So this is a really used often, especially when there's been a huge boost in equity in homes the way we've just had. Now, what a lot of people will do, and this is where I said before, we'll kind of combine. In fact, I just did this recently for my daughter. So my daughter had money saved up to buy, or she has money saved up and wanted to invest it in a real estate investment. But she's 18, so she doesn't have a lot of credit or anything, like that. But she did have enough money set up for a down payment. So we found a really good deal. She was able to get a condo in Surprise that was, the comps were 150. I was able to get it for her for 120. She didn't have the money, obviously, so we used the home equity line of credit to purchase it cash for her. And then we refinanced it and got her refinanced with a DSCR loan. So and she's 18. So she was, she wouldn't have been able to do that through traditional means. So that's how she was able to get her first rental property. So it's pretty common for people to use them in that way. And they work really well with the DSCR loans. A lot of times you'll buy an undervalued property or property that needs some fix up. You go in there, you can buy it with your home equity line and then go in and do the fix up, add some value to it. We call those value add properties, and then give it a little bit of time for some seasoning, sometimes just a few months. Then you can do a DSCR refinance and get your cash back out of it. And now you've got a full 30-year term loan on it, which is kind of nice. So that's a really common way for buying some investment properties. Any questions so far? All your little black screens? Okay, so before we go into the next two sections, I want to make sure, and if this is like way basic for you, I'm sorry, but I want to make sure everybody at least understands these two main things before I go on. Otherwise, it really will not make sense. So what you need to know is that there's two main parts to every mortgage loan. Now, this is your traditional type mortgages that you're used to hearing about and helping people, your buyers and sellers use and get all the time. Okay, so the two main parts of a mortgage or deed of trust is a promissory note, okay, and a mortgage or deed of trust. Whether it's a mortgage or deed of trust just depends on the state that you live in, okay? So they're basically the same thing other than that. You probably all remember this from your real estate school stuff, but the promissory note basically spells out the terms. So it says that you're getting a 30-year loan at 6% interest. You're going to pay it back the first of every month at this much per month and all that kind of stuff. It says who's paying for the loan, how long the loan's for, all of those types of things. If you're late on the payment, what's that going to look like, and all those. So it just spells out the terms, if you will. The mortgage or the deed of trust basically secures that property to that note. Okay, so it basically says, okay, promissory note, that's fantastic information, but what if they don't follow these terms? Oh, well, here's the collateral to go with that. Okay, so that works as the collateral for that promissory note. Okay, so that's how a typical mortgage or deed of trust works. Now, it's important that you understand that because it's part of what we're going to talk about in the next couple sections. So without having that, then you have an unsecured loan. So if I just gave you a promissory note, which I can do for anything, okay, if you loan me $100 and I say, well, I'll pay you next month, you could say, okay, well, I want you to write it here on this note. Okay, just so we have something in writing. Okay, that's a promissory note. Okay, that's an agreement that we made and it's in writing about the fact that I'm going to pay you. So without having that secured to a mortgage or deed of trust, that's an unsecured loan. So I have unsecured paper. I can do whatever I want with that. I can sell it, I can crumble it up, I can keep it and hold it against you and make sure you pay me, whatever. Okay, but once you have a mortgage or deed of trust, then that means it's a secured loan. So I have some backup and some abilities to do things if you choose not to pay this the way that you agreed to pay it, okay? A first mortgage simply just means that it's recorded first, so it's an order of priority, and then a second mortgage was recorded second, and so on, okay? So if you happen to get a HELOC, for instance, you have a normal loan on your house that you got when you bought your house, whatever, 5 years ago, you decide to go get a HELOC, the HELOC is going to be in second position for no other reason than the fact that they recorded in the county second to your original loan that happened 5 years ago. Okay, so it's all a matter of just timing. What a lot of people don't know is that anyone, any single person on this call or anyone walking up and down the street can write and fund a mortgage and secure it to a property. And that's where some creative financing things come in, which is what we're going to talk about. So we traditionally grow up learning about banks and mortgages and things like that. And we think that only banks can do these types of things. But any single person in the world, I don't mean single as in not married, but any individual person in the world can do these in any country or state or whatever, okay? So one of the common ways that people buy real estate, and this is one of my favorite ways, is through what's called private money. You'll hear people refer to it as OPM, which means other people's money, okay? The reason we like these as investors is that they're super easy to get, they're super cheap to get. I don't have any limits to the number I can get. Most of my private money lenders can get me money in 24 hours or less because it's simply a matter of them writing a check or wiring money to wherever I need it to go. And I also like it because I get to involve people that I care about and like and want to help in my real estate investments, and then they can make some money too. So private money loans are just simply loans that are made by private individuals who have money to invest. So you might be sitting there with an old 401k from an old job that you left, and you have $200,000 that's in there that is invested in some, fund that you're earning 5 or 6% on, and it goes up and down and up and down and up and down. Well, that you can take that out and put it into a self-directed IRA, and you can loan that to people like myself and investors that do what I do, that to invest in other real estate deals. And for that, you can get paid an interest that would be usually a lot higher than what you would get in a real estate or a stock market. And then it's also secured by real estate because you're getting that mortgage. So you have some extra security and safety in that respect. So this is normal people basically doing what the banks do, okay, being private lenders. The reason I also like them when I do lending to other people and when I'm using private money is that this is an infinite return to me. Because if I don't have any of my money in, but I'm making, let's say a simple deal, I'm buying and holding, and I'm making $200 a month cash flow. It's like you can do a lot of calculations on that depending on how much money you have into the deal and be like, okay, well, I'm getting a 8% cash on cash return. But if I don't have any money in the deal at all, then that's an infinite return to me. And so when you're doing it full time and you have staff involved and all of those kind of things, you look for the best possible returns. And private money is a lot of times the way that you can make that happen. Just like banks, private individuals get the same security and protections. They're going to want to have equity cushion. Okay, so the loan to value, there needs to be room for protection. I'm never going to buy a $500,000 house and ask for a $500,000 loan on it. Okay, because if the market turns, they're going to be upside down. Okay, so there's always going to be that equity position. And usually I don't put private lenders on deals that are less than 20% equity in a deal. Most people are kind of the same when they use private money. They also get a title insurance policy. Okay. They also get named on the hazard insurance policy in case the property burns down or anything else floods or anything like that happens. They will get a mortgage or deed of trust depending on the state that secures the loan to the property. And they also get a promissory note, which defines the terms of the loan. Now, every investor is slightly different in how much they pay their private lenders. It totally depends. A lot of them are deal driven. A lot of them might just have a standard. This is what we pay our private money investors. So whether you're looking at it from becoming an investor or you're looking at it from becoming a private money lender, there's two different ways to look at it. It kind of depends, but I tend to just work with the individual to see what they're currently earning and then make sure they're happy with what I can pay them. So if I've got somebody that has their money in a CD, a bank CD, and they're earning, 1.5%, and that'd be like really good right now, and I could pay them 4%, then they're going to be ecstatic, right? I've more than doubled their return. So they're going to be ecstatic about that. If I have somebody that's coming out of the stock market where they were making 8%, then I might have to pay as high as 10% to make it worth their while. So it kind of just depends a little bit. And every investor has it slightly differently, just depending on how they run their business. But private individuals and OPM is kind of a really easy way to get started once you learn how to find these people. So the benefits of private money for you as the investor, so I'm talking to you as if you're an investor right now, is it's faster, so you can get better deals and you can offer quicker closings. You can always get a better deal if you can say, I can close in 24 hours versus it's going to be 6 weeks. So chill out and don't stress about your foreclosure. Okay. It doesn't work that way. It's cheaper than hard money, and most often it's cheaper than bank financing. Now that's not always the case, but it's most often the case. You can confidently make offers when you know that you have money backing you. So when you're an investor and you know that you have access to unlimited cash, you're going to be a little bit more likely to make offers, and you're going to feel more confident to go out there and get started if you're brand new in the business. You can be more competitive with less costs involved. So if I'm doing a rehab and I have to estimate hard money in there and the cost of that might be an additional $30,000 to $50,000 depending on the hard money lender and the price of the house. So that means that that's $30,000 to $50,000 less I'm going to be able to offer to that owner, because I know I got to pay that in order to make profit, or it's going to come out of my profit. So instead of me making $70,000 on that deal, I might only make 40. So now it's getting kind of slim. Okay. So I can definitely be more competitive with less costs and make better offers to sellers when I know that I have private money behind me. Cash is king. So when it comes to getting sellers to say yes, a lot of times that makes all the difference. If I can close in 24 hours with all cash and they're walking away from a problem property they've inherited and it's across the country and it's just causing them more grief or whatever, and they're like, you're going to take that off my plate and you'll give me cash tomorrow for that, that is huge. So having private money allows investors to be able to do that. Way less hassles. Even if you go with a simple loan like a DSCR loan, you still got to do stuff. You know, mortgage people are, you know how they are. And you can pay full rehab and purchase price loans, which is nice. So I do like that a lot. And then you get to help people that you care about, which is also sweet. So like if you have family members who are curious about what you're doing and you're an investor and they want to participate, but they're like, I don't know anything about how to do that. I don't even know where I would go to find a good deal on a property. I don't know anything about how to fix a property up or anything like that, but they're curious and they ask a lot of questions about it. This is a really great way to be able to involve them in the process and have them be a part of it and make some money on your deals as well, without them having to learn the business, because they might have other jobs and lives and, you know, they don't want it to be their full-time business. It's just sort of something that they're curious about and interested in. So why would, from the other side, why would somebody want to be a lender? So they have money. Why would they want to lend to you? Well, they make more money by getting a higher interest rate paid on their money. So like I said, if they're in a CD right now, private money rates can blow that away. Plus they have the security and all those types of things. A lot of people do it because they want to be involved in real estate investing passively. It's like one of my, well, like 4 of my private lenders now are doctors. It started with one, and then he's brought 3 friends in, and they love the idea of being involved in real estate, but they're doctors. They don't have time to do it full time. They just like to be invested in real estate. So they want to have passive income coming in from real estate, but they don't have time to go out and look for properties and do all that kind of stuff. Investment money is secured to a hard asset. This is huge. Anybody who's ever lost money in the stock market loves this, you know, because stock market prices can go up and down on a regular basis. Even though housing prices can go up and down, they rarely do. They primarily go up. And then they're almost always going to come back up. Like, I mean, even when we had the biggest crash of our world, which was in 2007 and 8, it only took a few years for those values to be right back where they were. So you always have that hard asset that you can hold. So your exit strategy may have been a 1-year exit strategy. Now it's a 4-year, but at least it comes back. That doesn't happen when the stocks go down to nothing, you know. It is safer than the stock market and many other investments. The investment is insured. They get title insurance and they get hazard insurance. So if the house burns down, they're covered. They get their money back. They get title insurance in case there's any problems along the way and something wasn't inspected properly, title problems along the way. They want to diversify their investments. A lot of times it's a really good way for them to, you know, I'm in the stock market. I'm in this thing over here. I'm over here. I want to get into real estate, but I don't know the business. So it's another way for them to diversify. And then this is always a funny one to me, but there are people who just really like to be able to have that hard asset to drive by and look at. It kind of, I guess, gives them bragging rights about owning a home up the street and being able to show their friends and things like that. So that's another one. That's actually a kind of a big one, which is kind of funny. Being a private lender and people loaning on your real estate investment deals can be done through any retirement vehicle as well. So if they have a 401k from a former job, or they have a current IRA or any of those types of things, you can roll those into a self-directed IRA or a, like I have a solo 401k for my company. And there's different versions of that depending on how many people are in their retirement program or not. And so those can all be rolled into a true self-directed vehicle where you get to pick what's invested in. Now, many companies say they have a self-directed 401k, but it's usually you can pick from these 5 things on this list type of thing. A true self-directed IRA or 401k is like you can invest in anything pretty much except for a couple of small things, like you can't invest in precious metals and art and a couple of other little things like that. So it's not just a choosing from a list. It's like you can invest in real estate as an asset, which is kind of nice. And then the last one I want to talk about, the way to finance real estate investments, is owner financing. This is basically where the seller owner of the home agrees to accept payments in full or part for their sales price. Again, they get the same protections as the private lenders we just talked about. Okay, so this would be a situation most often where an owner has a house that they have that they either have a substantial, like a lot of equity, or they own it free and clear, or they have a loan that would be favorable to take over. Okay, so let's talk about the free and clear. They own a house that's worth $500,000 as an example, and they own it free and clear. They bought it many years ago for $100,000. They paid that off, and now the value has gone up, but they want to sell. Okay, they can, instead of getting a $500,000 chunk tomorrow to sell their house, they can accept payments and get a mortgage and a promissory note, just like back up 3 slides. Okay, so instead of selling it all at once and getting a big chunk of cash, they can just accept monthly payments for that. Now we'll talk about some reasons that they would want to do that. So that's one way. Okay, let's say they bought the house and they still owe $50,000 on it, but it's worth $500,000. Well, they can still do owner financing on it. Okay, we can do that in the term of a wraparound mortgage. So we would be creating a new mortgage. And we talked about this a little bit on the last training. The wraparound mortgage would be creating a new mortgage. I would still be making payments to them on a monthly basis, just like any other investment, and then they would be paying off $100 towards their $50,000 loan that's still left and keeping whatever's left over. So it's a good way for them to generate income and to make a nice cash flow coming in every month without having to deal with tenants. Okay, that's a primary reason that people do it. And then if they have a loan on the property and maybe they don't have a lot of equity, then I can take over their existing loan. So we talked about this one on the last training. If you remember, it was called buying subject to the existing financing. So a lot of times when people are going through a divorce, or another one is like they just bought the house a couple of years ago, maybe a year or 2 ago, and now they've got a job transfer opportunity, or they need to move for whatever reason, but they don't really have enough equity in their house to sell it without having to come out of pocket to pay. Because, it's like once you buy a house, you've got some expenses involved in that. They might have done some fix up work to it or whatever. Now, all of a sudden, if they want to go sell it with the expenses it's going to cost them and stuff, they're either going to barely break even, or they might have to come out of pocket for some money. So if that's the case and they need to sell it quickly, then what oftentimes I will do is take over their existing loan and let them get out of the house quickly. So I inherit whatever equity they have in that, but I'll take over their payments so they're not having to do that. So if they're getting a job transfer, going to a new area, they have to make a big monthly payment. They can't afford 2 of them. It's a way for them to get relief from that first payment. So those are some of the ways that you can do owner financing. There's about a gazillion different ways you can do it, but just to understand kind of the general concepts. So the benefits for you as an investor of owner financing are that it's faster, you can get better deals and offer quick closings, sort of like the private money. It's way cheaper than hard money and most often bank financing. So it increases your net return on investment because of course you don't have all those extra costs involved. You can be more competitive because you have those less costs involved. There's 0 hassles. You're just dealing straight face to face with the people you're buying the house from, which is awesome. There's no time delays or jumping through hoops. There's no proof of income, no credit checks, none of that. I've never, ever, I bought over 200 houses on owner financing. I've never, ever had a owner ask to check my credit, not once. No additional money costs. There's none of that. A good portion of loans that I've gotten through owner financing are at 0% interest. So 100% of my payment is going to buy down the loan. No limits on how many you can have because there is no limits. And then great for properties that are not lendable. And there are, some of those. Actually, I'm looking at a 6-plex right now in Central Phoenix, and they've added on like a bunch of different sections to the house. And so it's kind of one of those that is, it's got insurance on it. There's no loan on it right now. It was paid for by cash. And I don't think someone would be able to get a loan on it. So this is a perfect opportunity for you to say, well, hey, this property is not gonna be able to be sold from anyone who needs to get a loan. But if you can owner finance it, then I'll take it off your hands and start taking care of it for you. So that's a very good way to be able to use it for properties that are not lendable. Again, no credit checks. And then you can structure it so that you can afford it. Now, let me explain that. A free and clear owner owns a house, as an example, and you want to make an offer on it. If you go to a bank right now, let's say you're looking at a $500,000 house, you want to rent it, it's going to rent for about $2,000. If you go to a bank and get a loan right now on a non-owner occupied property, you're probably going to be close to 7%, 6.75-ish, okay? That's not going to cash flow. There's no way. You're not going to be able to do that because your payment's going to be higher than the $2,000 you can rent it for. So what you can do with an owner finance type situation is you can say to the people, you can say to the sellers, hey, I'll pay you. Remember, they own it free and clear. They have no payments to make on it. I'll pay you $1,000 a month for X number of months. Okay. And then you can add a balloon. I'll pay it off in full in 10 years if you want. Sometimes they'll say that, like, I'm 70, I'm not going to be here for 40 years, so you can add a balloon and things like that. But you can structure the owner financing so that the property can cash flow for you and be a viable option. So if I'm paying them $1,000 a month, and then on top of that, I'm paying property management and taxes and all that, now I have a $2,000 rental property and it's making a little bit of money. Okay. So I'm no longer in a negative cash flow situation every month. That's one of the huge benefits of owner financing. Why would someone want to owner finance? So why would a seller do this? Okay. It gives them a competitive advantage in a more balanced market. And we'll start to see a lot more of this now that we are going to start entering and becoming a more balanced market. In super hot markets like what we've seen in the last couple of years, you rarely see it, if ever. But when you start to get into a more balanced market, it offers a seller a competitive advantage if they're offering that and they have the ability to do that. Now, that's one of the things we talked about in the last training was, as an agent, these are some of the ways you need to know to be able to put your potential sellers in a situation where they could benefit from that, They like the idea of a passive income stream without the hassle of managing properties. They might be a burned out landlord already. They don't want to deal with tenants, but they like the income stream, and a big chunk of cash can not only present a tax burden for them, but it can also present a burden where they're just like, I don't know what to do with this. I don't know where to put $500,000. I know that sounds weird, but it sometimes is an issue for people. So it provides them a cash stream, and then it also can provide for their heirs as well, because you can write it up in a way that provides for their heirs, which is kind of nice. They already know the house and asset, which is something that's very familiar to them. So they know, okay, worst case scenario, if I don't make the payments to you, you're going to be able to get the house back in a foreclosure. I write into mine that they can have it back with a deed in lieu, and I just give them the keys back if that were ever to happen. So they already know that asset, and that makes it comfortable for them, which is a huge positive. They like the idea of keeping the asset on their personal financial statement. They don't have to take that off because they're still getting an income stream from it, which is kind of nice. They can often go get more for their house. So if you're selling with owner financing, you don't have to be as flexible with the price. If somebody comes in and says, well, it needs this work and it needs that work or whatever, you're going to come down on the price a little bit. But when you're offering something favorable like owner financing terms, you can oftentimes get market value or slightly above market value for your home, which is kind of nice. They can avoid large tax burdens from the sale. So depending on, obviously if it's a married couple, they can have, if they have to have lived in the house 2 of the last 5 years, to have that $500,000 come tax free. But if they have more than that, if they have a bigger estate, then they're going to have a tax burden for that additional amount. So it can help them with that burden. They can always sell the note for cash. So this is a whole nother class. We don't even have this one on the books, but a mortgage note can be sold for cash. So once that promissory note is created with that security of the mortgage or deed of trust behind it, If they want to sell that income stream, they can turn around and sell that and generate cash. In the note market in today's world, they could sell that for about 98% of value once it's seasoned for about 6 months. So once you've made 6 months of payments to them as the investor, they could turn around and get almost the full value of that out of there. So if they could sell their house for slightly above market, but then turn around and sell the note at 98%, they're going to come out at the same, at even. And in a balanced market, let's say fast forward where maybe market times are 4 months, they're able to sell quickly because they're offering that advantage. They come out ahead. So that's a huge one. It gives them a quick sale option because people are always looking for that as an option. So questions? How many of you are going to go out and buy your next investment property now?
Oh, even these are great ideas. Yeah, even just the DSCR loan to look at that, and then the seller financing. So, like what you're saying is in a more balanced market. Now, what would you say the sweet spot is to start bringing these offers to the table? I've been seeing 30 something days on market, you know, or would you target expired listings? So what would your angle be for trying to get seller financing?
Yeah, so I always offer seller financing when I'm meeting with sellers. I don't really base it on what's happening in the market. It's just how I do things. So it's always something I do. What form I offer has more to do with what their situation and their need is, and what they are trying to achieve. So as an example, if I go to their house and I had a meeting last week, actually not far from me here in Gilbert, and the couple is getting a divorce. Well, they just bought the house like 4 months ago. So they have zero equity in this house. And in my opinion, they paid slightly over what they should have. And so they have zero equity in this house. And then when you take the cost of all the loans, the loan that they got on it and all of those types of things, they would have to come to the table with about $30,000 if they sold through traditional means with a real estate commission and, you know, all of that kind of stuff. And so my question to them is, do you have $30,000 to sell your house? And they're like, no, we don't even have $3,000 to sell our house. Okay. So in that situation, then the only option for them to, in my opinion, is for me to take over their house payment. And so, and even that, it would be, it's not an ideal situation for me as an investor because there's no equity for me either. They just bought the house. But they do have a pretty favorable loan. They got in right before interest rates started to go up. So the rate's only like, I think it was like 3.5, if I remember, 3.6 maybe. So that would be a long-term hold for me. And so that would be the only option that I would offer them. If somebody has more time, has a free and clear property, or has a lot of equity, I'm always going to offer some variation of taking over an existing note and doing some sort of owner financing. So I don't really wait for the market to change to offer that as part of the solution. For me as an investor, that's just what I do. Now, if I was a realtor, I'm obviously a realtor, but if I was working as a realtor and my people were trying to sell their house, would I suggest to them to offer seller financing? And at what point in the market would I make that suggestion? It would be when I saw things sitting longer. Let's say average market time is 3 months. And they're in a situation for whatever reason that they need to sell more quickly than that. They found the house that they love already and they can't afford both mortgages, or they, you know, are trying to get their grandkids down. They're currently down in Sun Lakes and they want to get more into the valley because they just had their first grandchild and they can't imagine being an hour away or whatever. You know, there's a lot of motivations like that. I might suggest at that point, if they had a decent amount of equity or they owned it free and clear, at that point as a realtor, I would say, now, have you ever considered owner financing and do you even know what that is? And if they were like, I have no idea what that means, then I would educate them on what it means. And I would say to them, you know, it is an option that we could offer to a qualified buyer, which would help your house sell faster and allow you to reach your dreams sooner. If that's something that you want me to walk through and explain to you, I'll explain it. And then we'll have to get with your attorney to make sure that we get it all dialed in properly. So as a realtor, I'm going to make sure an attorney handles that.
And it's only because the equity would cause a tax event, essentially a taxable event that would, like, if they have a large amount of equity and they sell it, they're going to get taxed a large amount of money. So if you do the seller financing, you get the income, right?
That's not the only reason I would do it. I would suggest it to them because it would give them a competitive advantage.
Right. Okay. Yeah.
Yeah, that would be the main reason I would do it, because it would give them a competitive advantage, because there's a lot of buyers out there looking to buy a house that can't qualify for a mortgage, especially since things have tightened up over the last few years. But they're not bad people. They just, a lot of times, like, there's like, I don't remember exactly what the statistic is. I don't think any of our mortgage brokers are on this call, but there's a statistic I've heard, and it's something to the effect of, I may have this number slightly off, but that like 70% of mortgage rejections have to do with medical bills. Okay, now that's ridiculous to me. I mean, if you have good credit most of your life, but a bad situation happens to you and all of a sudden now you can't buy a house or anything like that, I don't think that's fair. So there's a lot of good people out there that can't qualify for a mortgage due to a situation like that. But they work hard, they have good jobs, they take care of their families, they do all the right things. But because of a unique medical situation that happened, and now they have this massive amount of debt, or maybe that debt's gone bad or whatever, they can't qualify for a mortgage. Well, would you, if you had the ability to be able to loan to them, wouldn't you do that? If you had the security of this asset that you can just say, if they don't make their payments for whatever reason, I get that asset back. So there's a lot of reasons to offer owner financing, but it definitely is because it gives you a competitive advantage where you can appeal to that market that wouldn't be able to get a mortgage otherwise.
Okay, cool.
And then another aspect of that market is young buyers. So you have young buyers who don't have any credit from that 18 to 22 year range. And a lot of people are like, well, yeah, but they don't have any money to buy a house. That's not true. These kids are figuring out how to make buku dollars early on, and they've got, you know, enough money saved up to be able to do a down payment, but they don't have any credit history because they haven't really achieved that kind of thing yet. And so if you had a young kid come in and say to you, hey, I'll give you a $30,000 down payment on this, and then I'll make payments to you for the next 30 years. Again, somebody without bad credit, they just don't have an ability to get a loan. That could be another option, you know?
Mm-hmm. Yep, I'm right here.
That makes sense.
Yeah, and then you had a question in the chat.
I'm trying to pull it up right now. It's not doing it. How about if they need the equity to purchase a new home they love, but their house is not selling and they have a contingency? What would you recommend? So they have, hold on, I got to process this data, Mercedes. So they have a equity to purchase a new home.
No, just resend it for anemia.
Somebody needs to go on mute.
Mercedes.
Okay, there we go. We got her. So they have the equity, or they need the equity to purchase a new home, but they love their house and their house isn't selling. Okay, so Mercedes, oftentimes they don't need all the equity. Okay, so a lot of times they do, and then if that's the case, there's not much you can do. But if they, let's say they own a house free and clear, if they have a $450,000 house free and clear, they likely do not need all of that equity to purchase a new home. So that gives you obviously more flexibility and more freedom. Also, if you're doing an owner financing situation, let's say an example, they have a $450,000 house that they own free and clear. I could talk to their mortgage broker and show proof that I'm going to make payments, that I've made payments on other properties in the past, and they will consider that contract much like they will a rental contract. So it'd be as though the sellers were renting to me in the way that they'll consider the debt to income ratio for their new house. So they typically would get about a 70% credit. So if I was giving them $1,000, just for simple math, $1,000 a month payment, they're going to, the mortgage person for them buying their new house would consider that a $700 credit each month. So in considering their debt to income ratio. So does that make sense?
Yes, thank you so much. I appreciate it.
You're very welcome. Any other questions? All right. Well, guys, I'll be doing the next training on investment stuff. And I'll be going into complete details on buying real estate with no money down methods. We'll go into the subject to even more, like some who's where, how's, and then I'll show a couple case studies so you can kind of get the feel for what those numbers look like. That will be on Tuesday, September 27th at 11 a.m. So for those of you time blockers out there, make sure you put it in your calendar now. And hopefully all my people are doing that. All right. Thank you guys so much for letting me entertain and educate today. And if you have any questions, don't hesitate to reach out to me.
Thanks,
Awesome.
Cortney.
Thank you so much, Courtney. That was
Yeah.
great.
Thank
Yeah.
you.
Thank you. It was
Seriously,
wonderful.
thank you.
Thank you. Thank you.
Thank you, Courtney. Very, very, very
Guys.
good. Very well put together. Appreciate it.
Thank you. Thank you.